Good morning. It's Friday, February 6th, about 6 a.m. Central Time. Super Bowl weekend, the last weekend that I can wear any of my Chicago Bears gear before the wife packs up everything in the closet and ships it to the storage unit. So let's get after it here. So looking at the precious metals overnight, the futures, they are higher after gold fell about 0.5% yesterday down to 28.56. And despite the dip in prices, it was the second highest close in gold's history after 3 straight record finishes. At one point yesterday, we did see the silver market sell off about 75-80 cents. Saw a lot of dip buyers coming to that market as well. It seems like there's quite a lot of resiliency and a lot of people want to own that precious metal coming into the close in the overnight sessions. We do generally see a sell-off right coming into the European close, and then we see that pickup just shortly after there, and it seems to get stagnant right after the New York closing market. So looking at the overnight price range, a little bit tighter here. So the high on gold, April gold, 28.9770. The low, 28.7960. So tighter range, about $20. So what that tells you is that gold is waiting for some catalyst in order to break out, and that catalyst is coming out a little bit today. So looking at March silver, the high 32.90.5, the low 32.63.5. So above that sell-off that we saw yesterday on that low. Areas that I'm going to be watching on the silver market on my charts, 32.25, 32.03, and then finally 31.88. We've been watching that 31.88 for the past several sessions here as it was an old resistance. Now it's coming in as a new support. So why is today my favorite day here? Well, we look at today's economic data and all eyes are on that January employment report. It's due out at 7:30 a.m. Central Time. The economists are forecasting a gain of 170,000 jobs, down from the 256,000 added in December, with a steady unemployment rate of 4.1%. Now, they're blaming some weather-related issues here for the decline, and then they're also going to do some adjustments here made in the areas of the calculation. So we're going to sit back with our plans. We're going to watch it and watch the price action. The reason why it's my favorite day of the month is because when I started off in commodities about 25 years ago, my boss would not let me take off Fridays if there was a jobs report. It was not acceptable. I had to go into the office, I had to answer the phones, place the orders for about the first hour and a half till after that jobs report came off. That was long before electronic trading was really prevalent. And then what he would do is he'd split me on $100 at the end, and I'd carry on my weekend a little bit early. So looking at today's action here, gold is steady near those record highs ahead of that jobs report. It's supported by geopolitical tensions and economic concerns. Now, a weak jobs report could boost the expectations for further Fed interest rate cuts. So what I'll do is I'll monitor a couple hours after, once things settle down. Was there any adjustment to the CME's Fed Watch tool? Like, are we seeing that March, the May, the June, the probabilities of that 25% interest rate cut increase in value? So I'll look at that, and then that's also part of kind of my weekend synopsis that I do on these markets. One thing that I do is I write a recap on Saturday and I write an outlook on Sunday here. I'll look at some of the charts, some of the things like that, kind of develop a plan going forward and outline my edges. If you don't get that, register for the Metals Edge and the link in the description below, and you'll get that over the weekend here. So the Citigroup, they did predict gold prices would hit 300,000 or 300,000. A little bit early for that one. $3,000 an ounce within 3 months here. So they are really looking at what's going on in the metals markets here, central bank buying, things like that, that have really been picking up. Now, coming up with a $3,000 call, if you've been following me for quite a while, I once it broke through 2,000, I said I was going to 3,000. Now, realistically, I think like 5,000, but that's going to be a 3, 4, 5 year out plan here. We'll see how things play out. Getting a little sidetracked here. So let's look at the best performing commodities year to date. Let's check on some of the top overnight headlines, and let's look at the things that are impacting precious metals in the commodities markets. Now, what I like to do on Fridays is I'll look at weekly performance. I'll also look at year-to-date performance. If there's something big coming out in the markets, like we have this jobs report and things like that, something to note that I'll see that coffee, one of the best performers year to date, up 28%, platinum up 13, soybean oil up 12, copper and silver up about 12. You scroll down the list a little bit, you got gold up about 8.5%. These are the futures markets, not the spot markets. But right below that is corn. Corn's been one of the best performing commodities buying gold, up about 8%. We used to call corn protein gold. The point that I'm bringing up on here is that gold and corn are up about the same amount year to date, meaning that if someone was to invest about the same amount in both corn and gold, and we were looking at it here today and you did equal parts, well, you'd be up about the same. The point of that is that there are many different commodities that enter bull markets. You don't necessarily have to sit in a commodity like the silver market and wait a decade for it to make this move. So I'm not hitting on silver. I'm just telling you that broadening, this is a metals-based focus program, but broadening it out and looking at the scope of other commodities out there is really important, and it'll get you more well-rounded on one of the things that are impacting specifically inflation, interest rate expectation, Fed policy, the dollar index, and then the ripple effect takes hold on the gold market and things like that. Now, corn futures, they fluctuated recently near the top end of the range as traders are weighing the outlook and demand for U.S. exports and sign of improving weather in South America. Better than expected showers in Argentina are expected, and also the rains in Brazil that can improve the production outlook, taking prices down. So question remains, how much was the damage done with the dryness and the heat? So Mexico is also looking at removing restrictions from generally modified corn, so that might improve some of the demand. So just take a look at that chart there. And what I'm telling you is you hear a lot of things about eggs and stuff like that impacting the inflation expectations, but really you should be looking at crude oil, gasoline, looking at the agricultural markets, looking at the softs and things like that. Like on the softs, cocoa futures, they dropped to their lowest level in a month, and they're signaling some weakness in chocolate demand. You look at the worst performing commodities year to date, volatility index down 12%, cocoa down 11.5%, OJ down 10%. So the point is here is that, these commodities, they go through these cycles, right? Where things happen. You get the tightness in the supply. You get oversupply. You get basic economics. You have increasing demand, stagnant supply, or decreasing supply. What happens? Prices go up. The opposite happens if the other things happen. And that's what we're starting to see a little bit here in cocoa as people are shifting. Now, the oil market, oil's headed for its third weekly decline as President Trump tariffs on China and the push for domestic increase in production really weighing in on the demand outlook. Now, we're seeing oil prices up here a little bit today. And on crude oil, not a recommendation, but just pointing this out, is that there is a seasonal that starts in February, started about yesterday at the close, and it was looking at that April crude contract playing to the upside for most of the duration of the February month. And it was the April contract. Something to note is that when I saw Trump announce that he wanted to have harder stance on Iran, he was giving maximum pressure. The front month contract moved up, but not as aggressive, or more aggressive was the second month out, meaning it would take some time for Trump to align his ducks in order to take that threat against Iran. This goes counterintuitive of what we see when we have an established relation, like with the Biden administration. Whenever they would do specific things or we'd see geopolitical tensions, the front month was the best month to be involved with, not some of these deferred months. So if you're going to play crude oil and you want to play some of these tensions rising, things like that, I suggest that you look at the next month or two out. So I know you had enough on these other commodities. So back to the precious metals. So the Bank of England says the tariff premium over gold is starting to really drive, and it's continuing to drive these gold withdrawals. I did a write-up last week that went on the weekend outlook where I wrote about it here and the impact of it. The interesting dynamic is that many people will send me articles about the dangerously low inventories on the COMEX and things like that. Now I believe we have dangerously high inventories on the COMEX, and that the overseas markets like the LME is really struggling. I did shoot out a tweet, and a lot of the tweets that I send out are not necessarily an endorsement. It's just something for me to timestamp and review later, but it says that things are about to get very exciting in gold and silver, and it talks about silver lease rates going up over 10% and absolutely exploding in the last 48 hours. So we'll see what type of impact that is. It's going to take a little bit more of a digestion. It's not something where you just see and you react to it. You really want to sit back with the popcorn, take a little step back, really review these types of things. Now, gold inventories held at the Bank of England's vault have declined about 2% since last year. Another thing that's very interesting, and these are not recommendations whatsoever, I saw a Bloomberg terminal story that talks about gold call butterflies. So you probably don't know what that is if you are an unsophisticated option trader, but essentially it's you buy one option, you sell two higher, and you buy one farther out. They're generally calculated risk, and they're a 1 by 2 by 1. But the important thing is that we saw a block of 2,500 of the September $3,000, $3,200, $3,400 call spreads trade at $29 each. The maximum gain on these things are $20,000. The cost of them is $2,900 plus whatever your trade costs are. But the point is that someone bought 2,500 of these, meaning it was $7.25 million. Someone bought the May, now this is May, $4,500 call spreads. They did 4,750 of them, and they also did them in July as another trade as well, 4,000 of those. So people are really bullish on this metals market, thinking that things could possibly come quite unhinged. Perhaps it's some kind of squeeze going on the physical side here. But that's all the time we got here today. For a technical breakdown, I didn't get into that on the metals markets. I did outline a couple levels in silver I'm watching. I do have a few things in gold that I'm watching, but really you want to go to the link in the description below and register for the Metals Edge here, and you'll get some of those weekend updates that I write out here. You got any questions, give me a call, 312-858-7303. Remember, futures and option trading, it does involve risk of loss, and it may not be suitable to all investors. Good luck, good trading, go get them, have a great weekend. Go Eagles. I can't stand. I'm done with the Chiefs.